The way a lot of real estate investors get started with investing is by using conventional loans. Now, a conventional loan is a loan that's given to you in person that's conforming with the rules and strict guidelines set by Fannie Mae or Freddie Mac. See, the reason why conventional loans have to be conforming is because the majority of banks package those loans and sell them to other investors, Fannie Mae or Freddie Mac. And banks don't actually make the money off of the interest from the loan. They're actually making money off of the fees they're charging you for writing the loan. Then they're selling them to somebody else. So that's how banks are making money, and that's why lending guidelines are pretty strict, because in order to sell them to Fannie, they have to meet Fannie Mae's criteria. Now, the good thing about conventional loans is they're generally 30 years long with a fixed interest rate. This keeps your mortgage payments very low. There's no risk of interest rates increasing on you. So you know what your payments are going to be for 30 years. That is huge. But they're difficult to qualify for. You have to have a low debt to income ratio, and that excludes most borrowers. You need generally high credit scores, and there's usually a high down payment requirement of 20% or more. And there's a limit on the number of loans you can get, usually 5 to 10 properties. It varies, it really depends, because they change the criteria from time to time. Another con that's not on here is that you have to own it in your own personal name. You can't own it in an LLC, which limits your liability, hence the name. You have to own it in your own name, which opens you up to liability. Here's some other considerations. Conventional loans use your debt to income ratio to determine your eligibility, which is fine as long as you have a lot of income and very little debt. But what happens as soon as you purchase a property? Your debt goes up. You now have a mortgage that you have to pay every month. And usually, conventional lenders do not count the rent income unless you're a very experienced investor with many years of experience, or the property has at least 2 years of income on it. Because what they do for income that's not from a W-2, a regular job, they take your income and they divide it by 24 months. They average it out over 24 months. So if you only have 6 months of income on your last tax return, say you bought it in the middle of the year, and so you only have 6 months of rent, they're going to take that 6 months worth of rent, whatever you earned, they're going to divide that by 24, which is 1/4 of what you really earned. A lot of them do that, and I hate it, but that's what a lot of banks do. So it becomes difficult for investors to purchase many properties because the conventional loans really slow them down. Now, there are something else called portfolio loans. Some banks actually keep the loans in-house, and they don't always need to conform because the bank has no intention of selling them to Fannie or Freddie. So if you don't meet one of the criteria, but you're very stable and they believe that you're an acceptable risk, they can still make the loan. Now, it's really common for credit unions and other community banks to offer some portfolio loans. They may not have all of them as portfolio loans, but some of them usually are because they're community oriented. So if you are banking with a credit union or a local bank, you can ask to see if they have portfolio loans for if you can't quite conform 100% to the Fannie Mae guidelines.